Hello, and thank you for joining me for a free No BS Forex training video. This is Mark. I am your host and educator. I am the lead trainer and trader at No BS Forex and also quantumforex.com. And right now we're going to talk about technical analysis. As you know, if you're following these videos, there's actually 8 categories. And the second category is technical analysis videos, and this is where we cover everything about how to place a trade, what to look for when you place a trade, and each trade video will be clearly labeled in each category, so you have no mistake about what you're actually watching. These videos are typically going to be 10 to 15 minutes long, so you can get a quick in and out. Okay, so today we're talking about the 11 o'clock channel trade. This is actually split up into 2 videos. The first one I show you the setup, and then the second one is actually later. It's time has passed and we've taken the trade, and you can see how over 100 pips was generated off of this trade. It actually ended up by being more, but that was the initial impact, was over 100 pips. So make sure you notice 2 different trades, 2 different videos, 1 trade setup, and I talked to you how to set it up, and then I talked to you about afterwards identifying what actually happened. So make sure to comment if you would on the video, ask questions, and I'll get those questions answered. Thanks, and God bless. Hello and welcome to a No BS Forex Take 5 video. This is Mark. Tonight we are covering the 11 o'clock channel trade. This trade gets its name because when it was first spotted and developed, it was done so from the Pacific time zone at the 11 p.m. Now that would be 2 a.m. Eastern, and what this does is take advantage of the London trading session by setting pending orders ahead of time at the 11 p.m. Pacific time zone time when this particular trade is set up. So let's get into the trade setup. We have a resistance off of the daily. This is a Euro USD. You can see our resistance level. We've come down somewhat on the daily. The 4 hour, we see a shooting star, and then we've channeled on the 4 hour. This is the hourly chart now. We have a resistance and we have a support. And we identify this trade actually on the 30-minute chart, where you can see that the price is being compressed between a resistance area and a support area, and it's also through this EMA 21. It's also setting above that. Now the expected on this is that it's going to go down and we're going to enter in the trade on a short. However, you don't need to know which way it's going to go with this 11 o'clock channel trade. Again, it's called the 11 o'clock channel trade because that's when you set your channel. That's not when you take the trade. You actually don't take the trade. You set the channel and you set your pending orders. Now we're going to measure this channel. The channel is 13.4 pips. Now typically what you'll do is you'll set your entry about half of the channel below and half above. Now the reason for that is typically this channel is about 30 pips, 25 to 35 pips, 30 pips average. So you're going to have typically a 15 pip entry on either side. In this case, we've gone with a 10 pip entry because this channel is only 13 pips, so we don't want just a 7 pip entry. Now these trades also typically during the London session and on into the New York will typically go 150 to 250 pips. The reason for that is because of the 70-30 rule. We know that 30% of the time we trend, so we trended down and we went into a channel. 70% of the time we channel. Now if you can see, there's a lot of these 30-minute candles that are channeling, getting smaller and smaller candles. We have about a little over 2 hours left for this channel trade to set up. Before then we would actually set these parameters like I have here. The idea is you set a pending order on a sell stop, a pending order on a buy stop, and you leave it. Now the stop loss for the buy would be where our entry for our short is. The stop loss for the sell or the short would be the entry where our buy is. So here's the idea. If we go ahead and enter this trade, we set our parameters, we set our pending orders, and this trade blasts down, enters our trade, and then shoots back up, maybe 50% retrace like we would expect, and then continues down, we're good on our short. But if it comes down, enters our trade, and moves back up, we get stopped out on our short, but we get entered on a long or a buy position. So either way, we catch this trade, whether it blasts out the top and then retraces and blasts out the bottom, or blasts out the bottom, retraces and blasts out the top. In this case, let's say that it blasts out the bottom and then retraces and goes through the top, we suffer a 35 pip stop loss when we include spread. But then if this trade goes 200 pips, we pick it up on the other end and we still have a profitable trade. Instead of making 200 pips, we make 165 pips, and we're good. Now, there is the occasion that it'll blast out the bottom, go back up, take out our stop, enter our long, and then head back down. Those are very rare. That's a very choppy market. And in order to reduce that risk, you look for this type of thing where we have a shooting star and we've had pressure to the downside. The expectation is this will drop through the bottom. If it doesn't, it's unlikely that we're going to drop and move up, but that does happen. And because that happens, if you want your total risk at 1%, because it could take out two stops on you, you would simply put a 0.5% in on a buy, 0.5% in on a stop. Yes, if it just goes straight down or down reverses or retraces and back, you'll only have 0.5% on the trade. But that's still better to make 150 pips or 200 pips on a 0.5% than to miss out on this trade by not putting anything in. And then as you gain confidence, if you'd like, you can begin to risk 1% and 1%. Once you get your win-loss ratios and risk-reward ratios figured out on this type of trade. Okay, so that's the 11 o'clock channel trade at 11 p.m. Pacific, 2 a.m. Eastern. You look for a channel on any chart, and on the 30-minute, any currency pair I should say, but on the 30-minute chart, set your channel on each side, and then the parameters are for the width of the channel. Typically, if it's 30 pips or more, you'll go half of the width of your channel is your entry pips. So from this point to this point on a 30 pip channel would be 15 pips. So you'd enter if the price moves 15 pips below your channel. In this case, we had a small channel, so we went 10 pips because the channel is actually only 13 pips. And that's the same case for a bullish entry. Set your pending orders, sell stop, buy stop, and your stop loss goes where the opposite entry is. You're good to go. Your pending orders are set. You go to bed, you sleep well, you get up in the morning, and you see how much money you made in your account. Okay, that's it for the Take 5 on the 11 o'clock channel trade. God bless. We'll see you in the next video. Hello and welcome to a No BS Forex Take 5 video. This is the 11 o'clock channel trade part 2, and this is to show the update on this exact trade that we just talked about and how effective it was. You can see here the 30-minute channel bouncing back and forth. These are the lines that we drew for the channel itself, and then our entry was 10 pips away on the sell, 10 pips away on the buy. For this sell entry position, this was a sell stop that was placed. You can see that the market pierced through, came back up, and actually retested right where our entry position was, and then continued and proceeded to move down. So it actually moved down. I'm going to measure here for you where we entered, and it moved a total of 105 pips. I had mentioned that 150 to 250 pips was fairly standard for these. So what we do expect is just to continue to move down. And what you can see is that we've actually broken the most recent, the higher low, so that was putting us bullish on the 4-hour, and now we're currently have broken that, and we're now bearish on the 4-hour. So we're going to hold that position and actually look for other positions. Plus our stop for that entry, the sell stop, was right here at our bullish entry, and now we've been able to move this down and place a stop behind this higher low right here. So we're actually protected with positive pips, and we're going to let this ride out. As these stages up, it could possibly come up to retest this high, and then we'd expect it to go ahead and roll back over. So if we do get back up near these highs, we would go ahead and put in, if we get a rejection candle on the 15-minute chart or the hourly chart, we go ahead and put in a sell and add to our position. And our projection on this is actually continues on down to the daily. Our next daily projection would be this support level, and then our next one would be the following support level. Okay, that's it for this take 5. I want to show you that this was a 100 pip mover, and at any time you are up 100 pips, you should have a strategy to take out partial lots and allow for a retracement, and then look for an opportunity to get back in. And you can learn that if you stay in the forum, and of course also on the other course material at quantumforex.com. Okay, until the next Tech 5, God bless. We'll see you soon.